Welcome back to another episode. Today, we are going to be going over some important stuff. We got the banking crisis, we got some news coming out of, Asia once again, and we also are going to be talking about demand and a lot more going on in volatility. All that and much more on today's episode of Money Never Sleeps. Welcome back to Money Never Sleeps. Before we get into anything, just a reminder, nothing I say is financial advice. I am not a financial advisor. Anything I do say is 100% my opinion. Always consult with your financial advisor or just make educated guesses based off research you do yourself before you make any purchases, buys, sells, any of that stuff. Has to be said each and every time. No JWeb, no house today. We'll have house back tomorrow. JWeb's still out of town, but I can see Chris, you're here today. Thank you for being here. Always pleasure to have you and everyone else here in the chat. So, and again, today is a little bit unorthodox. So if you guys want to throw in any TA in the chat, I'll look up anything. We'll do a little TA on that. Otherwise, we do have some news out of several sectors of the financial markets. The one I really wanted to start with today before I forget about it is demand driven. And it's one that we don't necessarily talk about too much on the show. So I'm going to pull up my screen share right here. So we're going to share the screen with natural gas for the time being. Okay, pull that up. I'll just move down here, and we're going to move this out of the way too for the rest of the show. Let's put this guy right there. All right, cool. So we got natural gas pulled up here. And the reason I pulled this up is because we talked about the other day how demand is pretty much dying out in terms of the oil market. However, there are things that are keeping the price elevated for the time being. But this is something that we haven't talked about since the beginning of the year. And again, I'm going to make two cases here. First case, obviously, is the fact that demand is the issue, and we're seeing the price of natural gas being reflected by that. The other thing that I think we could also make the argument is that maybe the weather, and that's starting to be a factor in why natural gas prices are coming down. I don't necessarily buy that one bit. Again, we're coming towards the end of winter. We got maybe another month or so. You would think that these would be doing pretty well for the most part in January, but in January the price was dropping significantly. So we're just going to take a look at this. We can see on the daily stochastic RSI, we are completely oversold on natural gas. Pull this up here. You can see that the height that we got in January was, where's all my data? Oh, there it is. Okay. You can see that the height that we got in January was about $3.42. The height that we got this winter was about $3.44. So from that high, we are currently trading at $2.11. So we could say that from there to there, we're down roughly about 38% or so on natural gas. If we compare that with, we can just pull up oil here, U.S. oil, new price scale, oil being the blue line. You can see that oil was obviously leading the push to the downside. We had a little bit of a rally here in natural gas. Now it's coming down significantly. We got a small rally here in oil. At some point, I think that these two are going to pretty much illustrate that demand globally is dropping significantly. Natural gas is just one that we haven't taken a look at, so I thought it was important to see if that's maybe another part of the narrative in global demand drying up. We know that the importance of oil in the economy is that it is pretty much a precursor, and also kind of shows you the actual state of the economy. As oil does drop down significantly, there is a good chance that the economy is tanking because demand is just so low. We rely on oil for much more than just travel. We rely on oil for manufacturing as well. And if there is massive unemployment, that means that there's probably not as much work going out. Means that there's probably less production. It's all tied within demand, and we are seeing that, I think, reflected in the oil price for the most part. Obviously, things in the Middle East are impacting that, but also natural gas itself is kind of showing that there is weak demand here. So it's going to be really interesting to see if that plays out, where oil starts to fall, and then usually if oil starts to fall, it doesn't stop. It goes on for quite some time. Let's just see what we got in the chats. Are there any charts that show demand overlaid with price? Don't know if TV shows that. I'm not sure of that. I'll have to look into that. you know, I would say, yeah, I would have to look into that for maybe one of the episodes this week, but I'm not aware of any charts other than just looking at oil and gas for the most part that show demand. There are some other ones that are pretty good indicators, but I think right now we're kind of in a skewed point in this market where we're just looking at everything and it just seems like nothing is exactly what it seems, right? So I'm going to pull up, just to get out of the way, we're going to pull up the S&P and to take a look at this guy again, because we are absolutely rallying once again today. We're up 0.8%, 40 points or so. Very close to hitting 5,000. We were about a point or so, point and 35, 1.35 points away from hitting all-time highs. Obviously 5,000 all-time highs, obviously we're at right now, but it's just very interesting to see that 5,000 level, which I'm going to put a line right here because I think this is going to be a psychological level for a lot of people. 5,000 is a pretty big fucking move for the S&P when we look at this, right? If we, in the grand scheme of things, it's like even in the COVID, pandemic stimulus era, we only got to about 48,000 or so, a little bit over 48, or not 48,000, 4,800. And here we are today with obviously much different set of circumstances, and we're rallying still closer to that 5,000 level. It's just a really interesting dilemma that we're in. Yeah, I can't justify the fact that it's going up when majority of the other stocks haven't even surpassed the 2021, 2022 highs, early January 2022. But, there's the 493 stocks that aren't tech, that aren't the Magnificent Seven. For the most part, most of those are down or, nowhere near their all-time highs. So it's really interesting to see that. I just want to pull up this gap here. Got another gap there this morning. Yeah, I mean, there's a lot of liquidity to fill in the downside when I look at the S&P and a lot of these other indexes. But again, I think the indexes, the big ones, the S&P, the Nasdaq, and the Dow, all for the most part are very skewed. You can't really say any of these are done for until big techs, for the most part, is pretty much crumbling. And if we look at some of those tech stocks today, we can see that that's just not going to be the case, right? Where are my tech stocks down here? Can't find where did I put them? Here. I mean, Apple for the most part still relatively strong, down 36 cents. That's nothing. Tesla up $3.64. Funny thing about Tesla is they're looking towards forward guidance of layoffs and the price is going up. Chris, you made a really good point to me earlier today that they're just looking at forward guidance, right? Revenue beats, earnings expectation beats and all that stuff. Year-over-year profits, a very different story when we look at Tesla and a lot of these other companies. It doesn't make a whole lot of sense, but that's what the market's pricing in. I don't necessarily know how bullish that is to see that layoffs are happening. That just means that there's going to be a lot less discretionary spending that's going around, right? Maybe a good jobs report is going to save us from that, but I don't necessarily see it. Look at some of these other ones. Obviously, everything else in the big, other than Apple, for the most part, everything else is green today. So that's why the Nasdaq and the S&P are so elevated. The interesting one for me today was the limit down move for the Russell. Obviously, it's bounced back from where it was, but it actually wicked all the way down to about 1939, 1940. It's currently at 1956, so it had a good bounce there. But for the most part, is it really doing anything compared to the rest of the market? I mean, it's up 0.12%, nothing compared to the 1% for the Nasdaq right now, almost 1% for the S&P, and almost 0.5% for the Dow. It's very tricky looking at this. It doesn't make a whole lot of sense. It just shows you that a lot of the small caps aren't necessarily strong, and the economy right now is pretty much riding on the back of big tech. You don't need me to say that, but it's just very hard to get an accurate, picture of what's going on in the markets when you keep seeing stuff like that. But it's something you have to keep in the back of your mind. So that's going to be really interesting to see as well how the Russell plays out if we do get a bit of a sell-off in tech, which is very possible, right? I'm going to pull up a few things here. Let's take a look at volatility, because volatility is really interesting here. I was mentioning earlier, I think I mentioned on the show maybe a few days back, that 1287 is a really key level for the VIX. And the reason it's a key level is because that's where this trend line has been bouncing off of, and that's where it was kind of resting at. And we did a pretty good job of hitting that today. 1287 was where we bounced from. You can see this white trend line that's down here is absolutely just finding support on the VIX. Now, the stochastic RSI for the VIX has been dropping like crazy, right? It's also trading this parallel channel. I don't necessarily know if that's going to lead us to one more push down, But I think if anything, we're seeing that it's getting harder and harder to crush volatility time over time, right? December, hard. It was easy to crush volatility. Then we got a bit of a pump, came back down, a higher low, and then same thing came back down. We tried to push it down further. We did momentarily, but it bounced right back up. You can see this gap up that we got here from Friday into Tuesday in January. So that would have been after MLK, I believe, that holiday. And we can see that the highs keep going up and the lows are continuing to go up. Again, that could be a setup for one more push to the downside. But at the same time, I also think that it's getting to the point where it's like insurance is extremely cheap on the VIX, and a lot of people might not necessarily be taking advantage of that. And that's a dangerous thing as well, right? I'm not even sharing my screen right now with the VIX, and I've been talking. I'm an idiot. That's why I miss the guys having them around. But let's pull up the VIX once again so you can see that. Here we are. This trend line right here is obviously been huge support. We're making higher lows, higher highs. It's really hard to, see this coming down. I mean, if it does, obviously that's a massive crush, and it's probably going to send the stocks equities up a lot higher. But I think it's getting harder and harder to push this volatility down. We got two big OPEXs coming up. We got OPEX next week, I believe, for the VIX, which is right around Valentine's Day. And we also have OPEX in March, which is March 15th or so. And, they've been crushing volatility for roughly how many months? Volatility has been crushed since October or so. So November. So what is that? Almost 4 months at this point. It can't be crushed forever. We're going to get a spike. The dangerous thing is that we're probably going to have to see a spike above 18 for a lot of problems to start. We could see a crush after it gets to 18, but as we continue pushing hard there's a good chance that we could start to see the VIX start to pump, and that causes a lot of trouble because a lot of people are trying to cover their positions that were shorting because it was easy to short the VIX. And guess what? Now they have to pay a premium to close their positions so they don't get screwed over. And if that keeps happening, that's pretty much a short squeeze for the VIX trade. That's a dangerous trade you don't necessarily want to be in. And I think that that's going to be one that's going to blow up a lot of hedge funds and a lot of these people who are just so overexposed to it. Again, easy money is not always easy. There always is catch. That would be the big fear I would have if I was shorting the VIX. But we know that I think that it's more likely that it's going to have a lot more room to the upside than it has to the downside. So it's going to be something that we're going to watch as the OPEX dates approach. But I do want to share something that's really interesting too, which kind of goes in with survival mode, is this tweet that we got earlier today from Unusual Whales. Let's pull this up. China's top hedge fund, Shanghai Banxia Investment Management Center, that manages 1.4 billion, sold stocks at a loss after realizing it must lose an arm for survival, according to Bloomberg. Now, that's pretty interesting because we know that the sell-off in China has been very brutal. I think it's to the point where we are realizing how margin and derivatives are a very dangerous market. And I think a lot of these people got a little bit too excited, and we're getting a little bit too excited here at the top as well, right? And that's just for the U.S. equity market. And we do know that derivatives were a huge part of the reason why we saw exposure to other countries in the great financial crisis. So it's going to be really interesting to see this. If this continues, I think it's going to be a reality where we continue to see a lot of these people sell off at a loss. It makes the most sense because, like I said, with that VIX trade, if too many people are lopsided, it's really easy to move the market in the opposite direction. I mean, let's put it this way. The VIX is in pretty much a low, and then you're going to get an all-time high in the equity market. It doesn't couple well. Something's got to give, and it's more likely that people are going to take profit up here at the top, especially if unemployment continues to rise. It's regardless of whatever the unemployment percentage is from the BLS. But I think that it's easy to take more off the top, and then you start to see some of that come in. That volatility pumps, people start moving their money into the VIX because maybe that's the pump that's coming, and then there you go. That's your short squeeze on volatility. House, thanks for joining. If you guys have anything in the chats, again, for TA, just let us know, or let me know, and we'll take a look at it. But I do want to continue on with China for the time being because we are also seeing some other stuff out of China that is really kind of funny. Here we are with CNN saying China is pumping money into stocks and markets are loving it. This by Lauren. Lauren, I think you need to relax a little bit here. It's been a few days. China is also, when we look at the grand scheme of things, not in a place where we can say we're at all-time highs, very similar to the U.S. equity market, right? So Chinese stocks, yes, they had a pretty good day, pretty good few days since Tuesday. Last night, we did see a bit of a sell-off in the Hang Seng. Nothing remarkable, really. I mean, the CSI is back. It was up, I think, 4.5%. But we can see that there is this type of sentiment out there and these narratives that are very, very misleading. I don't think there's a lot of money pumping in Chinese stocks that is investor related or offshore money coming in. I think that might be a bit of a stretch. And again, we're going into the Lunar New Year holiday. I think the Shanghai Stock Exchange will be closed for the week. I think it returns February 19th. But we're kind of seeing the markets in China being elevated going into that holiday. I don't necessarily know if we are going to be in the same place when people and investors come back to it. I think if anything, it's like if they were holding stocks and they're still able to sell stocks, while shorting or might be regulated for the time being. I think selling off the stocks that are currently held, that might be a possibility to see this push to the downside. That would just mean that they'd have to pump in more liquidity in order to pretty much soak up some of those negative prices that are becoming the equity market in China. But I mean, even just looking here at this CNN article thing, I think it's pretty funny to see this and see the 75 on the fear and greed index. Extreme greed is driving the market. Pretty funny stuff there. Yeah. So when we look at China, though, there is a lot of things that are going on here that are not great, but there's also a lot of things that are not great in terms of banking in just the global markets, right? We talk about NYCB. I'm going to share that right now. That got downgraded last night. It's pretty much cut to junk. And now Moody's is saying that there might be more downgrades coming soon, right? So if we look at this here, you can see that it downgraded it from double A or Baa3. They have the weird rating system. They don't just have AAA, BBB. It's a Ba2, which is considered junk rating. Pretty much is just crap. That's the type of stuff that we're seeing. And now New York Community Bank isn't necessarily a big bank. It is a big bank now because of what happened. Obviously, the amount of exposure that they had to Signature and how much they pretty much are over the capital requirement, in which they have to have a certain amount in their reserves. It's made it harder for them. They're not necessarily that big of a bank, though, right? So I think that, and again, Chris, we literally just talked about this too. No one's going to want to touch that debt if NYCB goes under, right? They're not going to want to touch that at all. We can see that there's exposure to a lot of these banks, and then months later, a year later, they're in the same place as those banks, where New York Community Bank is no different than Signature now, the ones that they bought the debt from. There's a lot of things that come in with this, and it's really hard for a lot of these banks to be buying up some of this debt. And you said it best, when they have their own problems. And a lot of these banks do have their own problems. One of those being UBS. I'm just going to pull this up here. Here we are. UBS warns of a significant extra cuts during the Credit Suisse tie-up. Thousands more jobs at risk as banking giants try and save a further $3 billion during merger. I mean, there's a lot of problems here with UBS, right? They have exposure to Evergrande. They also have exposure to Credit Suisse. A lot of things happen in the past year that are just not lining up for UBS. And we talk about a lot of these banks that just have these problems and buying up some of this bad debt. Well, here we are. This is what happens when you buy up this bad debt. Now, they bought a lot of debt of Evergrande back in 2021 when we first started seeing a lot of problems. I think that was like September 2021. And now we're seeing the Credit Suisse stuff pile up on them less than a year later. Now, I don't have too much data on UBS because they aren't an American bank. Obviously, you can see federal home loan banks and stuff like that from some of the other U.S. institutions. But I do want to talk about federal home loan banks and how those are also an issue for a lot of these banks going forward. We talk a lot about, the BTFP, the reverse repo. Well, that whole chart, the reason why we were so bearish on a lot of these banks stems from what happened with the federal home loan banks and how much they were borrowing from them in the short term, less than a year. That percentage of equity that was FHLB that was operating as equity. So it's really let's see, let me pull this up. Banks, got Citibank here. Yeah, okay, I'm on the right one here. But you can see that a lot of those banks were in a lot of trouble. I mean, some of the big banks, Schwab had an insane amount of federal home loan bank percentage operating as equity. It was the number 4, I believe, on the list. It had 130% of the FHLB as its percentage of operating equity. KeyBank, which is down, we can see on the chart here, down here, KeyBank is down on the year. Let's pull this up in the monthly. Let's do the monthly yet. Or this month alone, it's down 3. almost 4%, literally, as we're speaking. It even was even lower, as at 5% at one point. And we're starting to get extremely overbought on the monthly. And there's a lot of things that are really not lining up great for March. Now we're going to have no money in the reverse repo. That's going to be completely drained. So overnight purchase agreements and all that stuff, it's not going to be liquidity. And we're seeing federal home loan banks that are pretty much going to be drying up, and people have to pay those back. Well, they had to put up collateral. We're in a collateral shortage, and they're also putting that money up. They're going to have to pay it back. If they don't have the money to pay it back, well, then that collateral gets taken, and it's like, okay, well, that's a huge blow to a lot of these banks. So we're seeing that liquidity is going to be pressing on a lot of these institutions, and that's why we were very bearish on the banks, because they're always at the center of all these financial crises. Right now we're looking at the KRE for the month of January, down 5.21%. For the month of 5.21%. And then today, a few days into February, we're down 5.39%. So it's dropping significantly. You can see there's still plenty of room to come down on the stochastic RSI. We got rejected on the monthly from the 50 moving average. If we see something like New York Community Bank, which I'll pull up right now, NYCB, you can see that it's absolutely just tanking here. And, they bought it back a little bit today. It looks like it's trading at about $4.49. See how long that lasts. I mean, on open, they had to stop trading because it went all the way down to about $3.51. It's very dangerous right now for a lot of these banks. And the crisis that they said was over, and now they're saying it's a completely different crisis, that it's commercial real estate. It really isn't. Every one of those banks that are in pain are all ones that are bleeding because they bought the debt of someone that was much bigger than them, and that changed the way that their monetary system is structured for those banks. Small banks become big banks that just don't have the reserves on hand to protect customer deposits. You have the FDIC that was telling people to pretty much take advantage of the BTFP and other vehicles of liquidity. FDIC just wants to make sure that there's no banking crisis, because then guess what? They have to get involved. But when they are telling people and a lot of these institutions that, hey, take advantage of these vehicles while they're still in existence, well, what does that tell you that they're probably seeing? What does it tell you that a lot of these central bankers are probably seeing, despite keeping rates elevated? I think they're waiting for the first one to cut. Who's it going to be? If I had to say who's the first one that's probably going to cut, I would say China, PBOC, but that might just be wishful thinking there, right? It's going to be interesting to see who's the first central banker to cut, but once they do, we're probably going to see a lot of these issues even exacerbate worse. Where will the liquidity be without the BTFP? What liquidity? Probably won't be any, right? That's going to be the interesting thing. Rates at 5.5 are not helping the situation at all, and the fact that Powell is staying pretty much to the fact that, we beat inflation. However, we want to make sure we beat it. That's kind of showing that they don't have confidence that they actually beat inflation, or they don't have confidence in the fact that what's coming next is probably going to be detrimental. They can hold off as long as they can if they want to, but I think they don't understand the fact that the longer that they hold this out, the less debt that is created in the system, the faster that money is going to dry up. And if there's any type of situation, NYCB happens to a bigger boy, say Truist, Schwab, KeyBank, any of those ones that were in that list at the top, well, then what happens if we get a bank run and then they start seeing the exposure bleed into the other banks? It's really funny to see that, because I think no one's talking about it, but all the data is there to tell you. It's like liquidity is going to dry up fairly soon. I don't necessarily know where it's going to come from, in the short term at least, unless they change stuff regarding the rates. But it's pretty much just orchestrating this whole catastrophic event that's going to bleed out at some point sooner than they probably anticipate. And again, does that come down to an orchestrated event that they're planning? I don't necessarily know. Do I think that there's a level of stupidity from it? I think there's stupidity hidden in it. It's to some level of just not understanding how the monetary system works. But I think that's the reason why we don't hear it being such a problem. I think that's the fact why Janet Yellen says that everything's okay, and why Powell believes that the commercial real estate's the issue. It's not. NYCB's problem isn't commercial real estate. It's problem with Signature. UBS's problem isn't commercial real estate. It's Evergrande, and it's also Credit Suisse, right? So we'll be here in a month saying the same exact things and saying who's that exposed to a lot of this stuff. But for right now, we'll go from lack of liquidity to liquidity vacuum in a year when all BTFP comes due, elevated rates. Yep. And the Fed is trying to cut their way out of a mess. Yeah, exactly. I mean, there's nothing they can do. The fact that they're not cutting rates now is even worse problem than if they were, cutting rates in a month or two. it's just going to get worse by the time it gets to the point where they have to cut rates. It'll game over. There's nothing you can do to save it. So that's where we stand with the banking sector. It's not, as I famously say, it's not great. But yeah, there's a lot going on there that we just aren't being, we're not acknowledging. I do want to take a look at a few things regarding tech. We're going to look at some companies I would say had a really good time back in 2000 to a certain point, and it kind of relates to what happened or what's probably going to happen with a lot of these banks and a lot of these other tech companies. This is MicroStrategy. This is a company a lot of people know for Bitcoin. They didn't necessarily know that it was at one point valued at around $3,000 a share, a little bit over that, in the dot-com bubble. And I want to pull this up on the historical timeline because I want to show you. All right, this is right here, February 2021. This is where MicroStrategy currently is trading, right? A little bit under $500 a share. And here's the decade, actually 2 decades in between, where MicroStrategy pretty much lived after the dot-com bubble. Now, I'm not saying a bubble leads to companies going out of business. I just mean that their value in the markets drops significantly. Their market cap's going to drop significantly. Now, this is on the daily, and the reason I pulled this one up on the daily, because this is a really bloody chart. You can see that we got the all-time high, 3,300, literally to the penny, and then this is March 10th of 2000. By the time we opened the trading on March 20th, we were trading below $1,250. It closed down 61%, almost 62% for MicroStrategy, right? And now this is a company for months was just up only. Right? I mean, just climbing till we got to March of 2000. That's a horrible drop. I mean, you don't need me to say that. You can see how big of a gap this is. And we've never filled this gap ever. It's never been filled. So that's really interesting to see that. But it's also just shows you that once the bubble popped and everyone was kind of, disillusioned with a lot of these tech companies, nothing changed. I mean, nothing happened for 20 years. If it wasn't for Bitcoin, MicroStrategy wouldn't even be remembered. Michael Saylor would not be known for anything, really. I hate to say it, but it wouldn't be a stock that people would be talking about today. It would be somewhere down in the hundreds or so. It's kind of like a stable coin at that point, but obviously it's a massive dump that we saw there. Let's look at Amazon. Amazon was another tech company. Nothing crazy like that. But however, the structure in which it collapsed is very similar to MicroStrategy, not to the extent, but at the same time within a year. So that collapse that MicroStrategy saw, it was with 6 months it reached the bottom. With Amazon, it's a little bit different. It's about a year or so. But we can see that in that one trading day, from Friday close to Monday open, MicroStrategy just dropped 61%. Here we can see that we were trading at about, let me just pull this up. I keep pressing the ruler. About $5.65 for the all-time high right here in January of 2000 for Amazon. And we can see exclusively right here, right here around January, still maybe 28 days after that January 1st opened, Amazon dropped 47%. Now it did rebound. It did bounce back here in February 2000, but then we saw it was just nonstop decline for the longest period of time, right? What does that tell me? It tells me that there's probably a good drop coming, and then you're probably going to see a period of time where it just continues to drop until it finds its bottom, right? I mean, this from here to the actual bottom, it's about 446 days, right? So it's December, let's say January 2000 all the way to September 2001. And then obviously Amazon has rebounded significantly in the time since, right? But we could see that how much pain this saw, even for a company that wasn't necessarily worth what it is today. It's a very dangerous place when you have some of these bubbles because it just pops so fast. I mean, a month later, we're down 47%. That's absolutely insane. I mean, we can even take a look at some of these other ones too. Let's take a look at what's another tech stock that we saw. Oh, big boy, Cisco. Now, Cisco is really interesting because it's still relatively it's still around, right? Yeah, I don't necessarily know how much value Cisco is to the world today as we speak, but back in 2000, look at this chart, shot all the way up to about $82, and this is on the monthly. So we can see that in the 2 months that followed that all-time high, we came down 17%, almost 18% in May of 2000, and the month prior was 10%. So total, we can see that in those 2 months that followed Cisco's all-time high, we had dropped 40%. kind of similar to Amazon. And then after that, we had 3 months of a rally, which is kind of your wave 2, before we had another a couple of red months where it dropped us down 77% in those months that followed. And then if we look at this from all-time high to the bottom of the market, where it finally did bottom out, trying to get that there, we're down about 90%. Now, the reason I bring this up is because when these bubbles do burst, they are bad, and it actually happens pretty fast. And, I think there's one for sure that we can kind of say is a very similar structure as it approaches $700 in the trading day, right? Got to zoom out on this one. And just to remind you, NVIDIA was trading back in 2013, roughly $4 a share. I'm not done. I'm still zooming out. Still zooming out, guys. Still zooming out. Boom. Look at that. So let's take a look and just apply some of that math. Let's say, I'm not saying NVIDIA is going to drop 60% in one day, or, from Friday close to Monday open. But let's say what a 60% move to the downside would look like for NVIDIA. Where does that put us? Does that put us anywhere? Oh, look at that. Puts us right at the 50 moving average. So that's really interesting, right? That puts us right there, which puts us around $274. Now let's say a 40% move. See where that puts us if there's any support from there. 40% move to the downside. Yeah, puts us right there around 406, which is kind of where we were waiting to see if it would break from. It also fills that liquidity gap down here. It's kind of hard to see, but 406 is roughly right down here, and the liquidity gap is sitting around 420, 430. So that would be filled completely. We also have this massive gap down here that would need to be filled as well. And I think that it's very possible that we could see NVIDIA, if this is a bubble, and say we were right here and NVIDIA is a bubble and tech's all a bubble, there's a good chance that we could see this thing drop in a few months significantly fast. We would find support obviously here is where support wasn't back in November of 2021. I know J-Web's just rolling in his grave listening to this. Again, he's not dead, but if he was, he would be absolutely pissed off and trying to find some way to find me and choke me out like Homer Simpson chokes out Bart Simpson. But this is probably where we're seeing they're probably going to see this move if this is a bubble, right? I think Meta is no different. This is an absolute insane rocket to the upside. Think about value and think about what they're offering. NVIDIA is a company that has a $1.72 trillion market cap, and the revenue in Q4 was only $16 billion. Seems extremely heavy, extremely overbought. I'm not convinced that this is something that's going to last forever. And I think that as we do see a lot of things pull back in the market, primarily tech, you're going to start seeing a lot of this other tech euphoria kind of bleed out too. Amazon, they've been through it. I don't necessarily worried about that. And again, I'm not saying any of these companies are going to go out of business, but a lot of these companies were just overvalued, and they have been. And the COVID pandemic and stimulus really distorted our perception of how much these companies are probably really worth. I mean, the fact that, and I know they've had stock splits, but Tesla is trading roughly down here around $23. I mean, percentage-wise, compared to where it went all the way up to at around 410, obviously stock split. Keeping that in mind, that's, look at this rally. This is, over 3,000% rally. Is it really worth that much? That's something you have to question. If that money's not there, if the liquidity is drying up globally, guess what? It's not probably worth what it was worth in 2021. 2021 is an absolute anomaly. You will never see something like that again unless they just want to print billions of dollars, the most amount of money in U.S. history. And obviously, and if rates are at 0%, something like that could happen. But if rates do go to 0% from here, it's not because it's a bull market. It's because something is broken, and it's 100% banking system and just how the monetary system works, right? You're going to call bullshit on it at some point. They're just not going to let you know when that happens. Yeah, that's pretty much all I got from the tech side. I'm just looking back to see if there's anything else we need to cover, but for the most part, I think we did a pretty good job on that. Oh, I guess we got to talk about Bitcoin, right? I've been tired of talking about Bitcoin just because it's been so fucking boring. And again, I'm not saying it's a bubble either, but it's definitely due for a 40% correction. If we are believing the narrative that this time is no different, the halving is going to send Bitcoin to the moon. Well, okay, then let's look for our 40% retracement that's due for us. 40% or so takes us about 29,000. If we look at this on the weekly, probably find the moving average around there somewhere. All right. Let's go from the heights down to 40%. Close. We're not too far from the 200 moving average, but it's in between there. And you can see that the weekly is getting nice and oversold. I think a lot of people are really getting bullish on this. But again, we have to look at a few things that are out there. Parallel channel, it's an ABC corrective move. We already got 5 waves down here. This is pretty much, obviously it's an ABC pattern, right? To the correction to the downside. 5 waves down, 3 waves up. And again, I'm talking about like this type of 3 waves. A, B, C, nothing in the subwaves. There'll be 5 through 5s and all that. But we're expecting 5 waves down. Wave 1 will probably take us somewhere around that 40% move. We'll get a nice little bounce. Then we're going to probably see a really bad wave 3, maybe another bounce, and then we'll take us to our wave 5, which should end this bear market, where that lands. This time is different. I think that's kind of the mantra that a lot of people have, and it's wishing one hand, shit in the other, see which one fills up first. I can guarantee you that you're going to have a pile of shit in your hand at that point. But so look at this here. Is this an ABC corrective pattern? This is our wave 2. That's what we're looking for. Where could that take us? Maybe around 45,000. I think that's possible. I was hoping that would go a little bit deeper so we could have something a little bit cleaner. But this looks like the ABC pattern that we're putting in for the time being. Unless something changes, this could be extended to XYZ, something WXYZ, some stupid pattern that's a little bit elongated, some similar to the Russell. But for the most part, I think that we're in a wave 2 right here. We're going to see if we can break above 45, 46 or so, maybe the height. I don't think we're going to put in a new high. It's possible we could, but for the most part, as long as we start to see, this wave go up here and there's no signs of any more correction, needed, then there's a good chance that we could start to see our wave 3 begin, which is going to probably take us down to that level, that 29 or so thousand. So maybe even this 5 wave within this first wave of the 5 wave to the downside of the macro could be a little bit shorter, but I do think that we are going to end up somewhere around that 29 to 30,000 level, which is where we pumped from back in October. It just seems like that's going to be a lot of liquidity. We're going to have to watch the funding rates and all that stuff. But right now, it just seems like Bitcoin's just kind of trying to chug its way up. It's been very boring. Let's look at the volumes. Volumes are dead. I mean, this is ridiculous, guys. Price going up, volumes coming down. That's bearish divergence. That kind of lines up with the fact that we're in this corrective pattern. Let's see what Bitcoin USD looks like on Coinbase. See if the volumes are any different. Exact same. Volumes are dropping significantly. Price pushing up. Are you happy that you got your ETF? I think that's the big question. But yeah, looking at that, looking at some of these other altcoins too. Bitcoin down, it's still relatively high. Matic. Some of these are bouncing here. Matic just pulling this up. That's an ABC corrective pattern. A, B, C. I mean, it's cut it. That's a clean pattern there. ADA is doing something different there. Let's see how that plays out. A, B, C. Maybe this is done. And see Link. Link's actually doing a little bit crazy here. Wow. And again, there's going to be these anomalies within the patterns, but Link's also one of those ones that has just a weird chart where it's just consolidating sideways for so long. But this looks like 5 waves, right? Wave 1, wave 1, wave 2, wave 3, big wave 4, wave 5 extension. Makes sense. Once that's done, they're probably going to see some corrective pattern to the downside, but I don't think the low is in for any of crypto. And again, I mean the cycle low. At the very least, I think we will touch 20K for Bitcoin. If these patterns do play out, again, I have no idea if they are or not. My conviction is still I'm probably going to be looking for Bitcoin to get a wick below 10K. I know that's a ballsy thing to say, but I think lining up with our whole thesis of what's going on in the monetary system, how liquidity is going to be drying up, I have no reason to not believe that. Again, it's really easy to get bullish at the top. It really is, but then you have to remember how fast some of these things can really get out of hand. But yeah, I think that's about wraps it up for today. I think we went through a lot of stuff. My main concerns, obviously, are going to be watching the banking sector. We're seeing the reverse repo kind of fluctuate between 530 billion, 550 billion. It's back and forth the past few days, so nothing notable there. Bank term funding program data, I think that comes out tomorrow, so we'll be on the show tomorrow. We can talk a little bit about that. We should be here with House tomorrow as well. And yeah, just watching these. It seems like the market moves when the market's not open. That's where most of the news is coming out of. So during the day, it's just kind of boring, up only, right? So that's what we're kind of looking forward to. I appreciate you guys all for being here. It's a little bit longer than I anticipated, but got through a lot of stuff today. We'll be back tomorrow, hopefully regular time. We'll let you know via Twitter. But appreciate everyone being here. Before we leave, likes, thumbs up, all that stuff that J-Web says. He says it way better than I do. But stay safe in the markets, and we will see you guys tomorrow. Have a good night.